The Fed chair speaks today, and the Fed also raised the federal funds rate by 75 basis points. How is this going to trickle down into the real estate market, and what is it going to do to your pocketbook as we move forward? Let's go ahead and get all that information right after this. Welcome back after the break, everybody. Here, Mike Petras, your Star Realtor of Star and the Treasure Valley, back again with another episode of Mikey's Mortgage Update. I'm not going to really call it monthly anymore because sometimes it really kind of scatters out in terms of, getting direct answers from the Fed and what is really kind of happening here in our economy. But as we all kind of know, I think that you all saw the CPI or the inflation report that came out the other day. It did raise up to 9.1%, even after the Fed said that it would cap out last month, which it actually didn't. So we did go up today. The Fed Chair Jerome Powell did speak, gave us projections of what's really happening here in the U.S. economy and what the Fed is going to do to be able to tackle things in the future to be able to lower inflation back down to a 2% threshold of where the Fed likes to be. So let's go ahead, let's dive into all this information and let's go ahead and break it down in terms of what they've done and really how this is affecting mortgage rates, or is it compared to what it could actually affect you and your pocketbook. Let's go ahead and get into that information right now. So if you actually haven't heard by now, the Fed actually came out today. Jerome Powell did speak, as I mentioned earlier in this video, but the Fed increased the federal funds rate today by 75 basis points or 0.75% in order to combat the inflation that is currently happening here in the United States. Of course, they did that last month, and then the prior month they went up 0.5% and actually now cracked the 2% barrier here in the United States for the federal funds rate, which is now sitting at 2.25 between 2.25 and 2.50%. So what does that mean when the Fed actually does raise the federal funds rate? And really, does that affect the mortgage rate when it goes to going out and applying for the house? Of course, the definition here is the Federal Fund Reserve uses certain tools to adjust this rate because it influences other interest rates, such as those that you pay on credit cards. It does say mortgages, but we'll get to that here in a minute, and various other bank loans that you got, especially if you're looking in the commercial world to be able to buy a property in commercial. Commercial mortgages actually tend to be on the federal funds rate a lot more than residential mortgages do. So where do really the 30-year fixed mortgages and the 15-year fixed mortgages really kind of get their backing from, and how does that really affect when they adjust the federal funds rate? And technically there is a small correlation, but really broken down though, the UMBS or the Unified Mortgage-Backed Securities, okay, especially on a 30-year note, is what really kind of controls and sets the bar for mortgage rates happening. So I would just want to go ahead and come over here to Mortgage News Daily. I love watching this site in order to be able to see where mortgage rates kind of stand. And what we have noticed, especially over the last couple of months, is that when they come out with the new CPI report or the new inflation report, every time that they have not been able to handle inflation, except for this time through, for some crazy reason, you notice that investors really kind of dumped out, and you notice the interest rates coming up. They did hit a low of 98.25, and that was back around June, when the rates went up to about 6.28% for a 30-year fixed loan. Ever since then, investors have really kind of been jumping into this market. Now, I can only speculate as to why they're doing that, and my guess would probably be that they're really kind of losing in the stock market, and they're looking for an investment that's not going to hurt them so bad in the long run. The Fed could also be investing back in here. I just really don't know who's really investing into this. But as the number gets lower, what you need to keep in mind is that the rates will come up. And the higher the number they get, the higher that number gets, okay, for the price, will actually lower the interest rate. So if we're looking at what happened today and what's actually really been happening now here in the UMBS over the last weeks or so, we've noticed that the price has been going up. So these investors are really kind of keeping the mortgage rates, okay, or the interest rates at bay for what you're going to get on a 30-year fixed or even a 15-year fixed if you're looking for this. Normally it comes off the UMBS 30-year at a 4.5. There's a thing called par with all of this, and they'll change, eventually how much they're offering the interest rate on compared to how high the price goes. That's really kind of out of my league. If you want to know more about that, sit down with a financial advisor and talk with them, or sit down with a mortgage lender. But, as the basic general rule of thumb here goes, is that the higher the price cost overall, it's going to lower the overall rate that you're paying in interest. And even today, we broke the 101 mark. So we have been steadily on that rise. And if you pay attention to where the 30-year fixed rate is, on a daily basis, like I do, I've noticed that it's been coming down and coming down. Today, we're actually sitting, if we can take a look up here, that we're sitting at 5.544% for a 30-year fixed rate. Okay, and that was just kind of incredible. It's wonderful how it came back all the way down 3/4 or 75 basis points from where we were at really just about a month ago. So we're getting that savings, back in there. And I'll kind of talk a little bit more about what Jerome Powell was talking about and where this position basically is. But getting back to the federal funds rate. So is it really right now, it's squeezing, okay, the pocketbook? We have noticed it's not really people coming out and listing their houses, especially here in the real estate market, that's really wedging that gap. What is really happening is that the buyer's market is dropping off and not going out there and actively purchasing the houses that we saw, say, a year and a half ago, or even 6 months ago. People right now are really feeling it in their pocketbooks. And we all know that as the consumer price index goes up, inflation goes up, it's just squeezing more money out of your pocket. And what is a good reason that this is happening? Well, if we go, actually, I will get to that here in a second. If we go to the consumer price index, one of the major things that we have seen is literally the cost in energy as it comes across. We all know that Biden and this administration is absolutely declaring war on basically your pocketbook. They are declaring war on energy. They're reducing leases that are there. They're actually shutting down leases that were available. They shut down the Keystone Pipeline. And really, anytime you're messing with energy, you really filter that to every other category that we see, especially food. Food is another thing. And Jerome Powell actually did touch upon that today when he was talking about food. He was saying that we have noticed that Americans aren't eating as much. They're not going out there and buying as much food. Well, no kidding. And that's actually a very, very scary thing if you think about it. And if we go into a little bit more policies, we can talk about, fertilizer, how that's being cracked on because natural gas isn't having the production that it is. And at that point, we're kind of really getting political at this point. But it's literally the administration is really shutting down things without having an ulterior motive or an ulterior green energy source that can compete with where our energy sources are today. And really, they just can't, and they're not as effective, but they are just creating this war that we are seeing all the time. There's a really great article here that really breaks it down at heritage.org when it talks about energy economics and what is going on with this administration. And it's basically saying that, unfortunately, it's clear and demonstrated aspiration of too many European politicians and the Biden administration, along with them, to prevent new infrastructure for oil, gas, and coal production to be built. So they're locking it down. They're shutting down these things, which is, when the demand is still there, there's still a very, very high demand because a lot of us are still using gas products. We still heat our homes with natural gas. We still need to get to work. And they are really just chopping down the availability that we've got. And as long as that's going to continue to happen, inflation is going to be on the rise and cost is going to be on the rise. And we all know too, if we're taking a look at our wages compared to where the CPI is today, we are definitely not making the wage increases to be able to keep up with the inflation that is happening. So it's really taking it out of your pocketbooks. And that is really, if we're talking about real estate, buyers are not out there actively as much as they were a year and a half ago, because they are concerned about their pocketbooks, and they have every single right to be. So if we come back between the mortgage securities, which really kind of sets the bar for, mortgage interest rates, we're doing okay. We're not doing terribly bad. But the federal funds rate, though, is getting in there and squeezing the pocketbooks, which is changing what is happening in the real estate market today. If you do watch Mikey's monthly market updates, or you haven't yet, I do recommend that you go ahead and watch that last video, because here in the Treasure Valley, we are starting to see that impact now. We're starting to see market corrections come to the overall value of homes, and the median home price is coming down. So it is starting to have its effect, because the buyer's demand is slipping. So moving along here, I just want to go ahead and point out there's also the 15-year UMBS that we have, and you can see that the actually came down 91 basis points today, almost a full point. And if you look at where it actually stands today for the 15-year, you saw the overall interest rate on the rise. So if you really want to kind of keep in touch of what's going on here, especially when it comes to the rates for your interest rates on a mortgages, look at this website here at Mortgage News Daily. It is absolutely wonderful to keep you in the loop. All right, so let's go ahead and let's move on with some more information. All right, so I did go ahead and I watched Jerome Powell's address that he gave to the nation. And of course, he's going to do that every single time that they meet, come out and really kind of make his predictions for where he thinks that the economy is really landing and where the Fed is kind of positioning themselves. Now, if you ask me my personal opinion, I honestly agree with 75% of the other economists out there in the United States right now, saying that the Fed is taking it too easy on inflation and where it stands right now. Again, I want to reiterate that last month they had said that they're hoping that the CPI, or the inflation rate, would have been capped, this coming up report. And what is interesting is that it didn't cap. And what is actually even more interesting is that usually, if we're looking back into the mortgage-backed securities, the UMBS, every time inflation has gone up, investors really got scared, started dumping off their stuff. And it started jacking up the price of the overall interest rate that you'd pay on a 30-year fixed note. Well, this month it didn't happen, which was kind of crazy. Now, are we out of the woods yet? I mean, could it happen, a couple of days from now? Who knows? I'm not that, savvy when it comes to the financial market to be able to give you that answer. But I do want to just kind of say, some of the key points that Jerome Powell had said. And one of the key points is, if we're talking about the labor market, he came out and he said that our labor market is really, really strong. Of course, as people were returning back to work from the COVID pandemic, which there's a lot of, the current administration has taken a lot of credit for, saying that, hey, we've created, record job increases. Really, have you? Or is it just people returning to work? Well, I like to consider the latter. So he does still say it is strong, but he also came out and contradicted himself. He said that he sees some softening in the labor market, and that totally makes sense. As the federal funds rate goes up, these employers, especially if they need to get these goods and services and they need to get loans to do it, it's going to cost them more money. So what are they going to turn around and do? They're going to start laying off their workforce. And honestly, I see that around the corner. I see a lot more softening to what is going on. The next key point I want to bring up is he was talking about whether or not we are currently in a recession. And a lot of these reporters that asked him that question, and of course he said, no, I don't think so, given the statistics and the data that he's able to look at. But if you watched another video that I did come up with about a month ago, talking about the recession and the indicators, really two major red flags are coming out, plus others. And that is going to be, we did have a negative GDP last quarter. Okay, that's our gross domestic product, okay, that we produce here in the US. And the the GDP report for quarter 2 of this year is going to be coming out tomorrow, and they anticipate that to be in negative. And all indicators generally say a recession, when you have 2 quarters of negative GDP, you can expect a recession right around the corner. Another big indicator, which happens 85% of the time, that recessions occur, is when the employment rate is under 4%, but the inflation rate is above 4%, which is also there. So is a recession, in my opinion, and a lot of other economists' opinions, right around the corner? Absolutely. So when the recession hits, though, which is good for homeowners and people and buyers, especially going out to purchase a home, is that historically interest rates will come back down as a recession hits. So do I believe Jerome Powell? Do I believe that he honestly thinks that no recession's coming, he can bring this in for a soft landing? I think that he thinks that, but all the indicators are showing this right around the corner, and they're going to continue to raise the federal funds rate if they cannot cap and start tackling inflation. So I just see that. I believe that honestly, the federal funds rate will probably hit about 3% by the end of this year. And there's a lot of economists that really say that he's taking it super easy. They're saying that the federal funds rate should be around 5 to 7% right now in order to tackle this. And if you look at some other Fed chairs, like back in the 80s when things were really, really bad, Volcker came up, he jacked up the federal funds rate to astronomical levels, corrected the issue. Greenspan did the same. Powell just seems to be on a different page here. He wants to try and commit the soft landing, but with where he's going with the federal funds rate, you could almost anticipate a hard landing and a recession to follow up. So just kind of touching on those problems. He still said also that there is supply chain issues, which is also another, effect to our economy here in the U.S., and we all know that. And I did mention that he did say that there's a decline in food consumption by us everyday Americans. Well, no kidding. That's very, very scary for us. It really is. And he actually said that he feels that the federal funds rate is closer to where it needs to be now in order to create that soft landing. But we just haven't seen him do it, especially when he was saying last month that it was going to cap out. And in the end, it really didn't. So we're really still in a pickle here. The administration keeps spending lots and lots of money. Energy costs are through the roof, which is kind of trickling down to everything. The federal funds rate really, in my opinion, is not where it needs to be. But luckily in the housing market, if we are thinking about the interest rates overall, we do have investors going in there and buying up the mortgage-backed securities and keeping them generally at bay. So we'll just have to continue to watch the reports as they come out, watch the GDP report as it comes out tomorrow, and really see what is going to happen here in the United States. So we shall see. All right, everybody. So let's kind of summarize what happened today and talk about my final thoughts in terms of what to expect here in the real estate market right here in the Treasure Valley and how this is all kind of going to roll out and affect things. So literally, as I've mentioned in prior videos, it was correct, okay, in terms of when the market corrections would start ushering in. So let's go ahead and let's start off with buyers. Okay, because buyers right now, you're probably in a holding pattern. Most people throughout the U.S. that are looking to buy are in some sort of a holding pattern right now, unless, of course, they need to make a move out to somewhere or etc. So what is kind of going down right now here, especially here in the Treasure Valley, and if you watch Mikey's monthly market updates, we have noticed that we are at the beginning of the market correction, and we are starting to see some of those median home prices come down. Now, I've also heard, a lot of rumors of people, hoping and anticipating that this is going to turn into another 2008 crash. Well, I can tell you it's not going to, okay? And because 2008 was really for a whole nother ball of wax. And, one of these days I'm going to go ahead and come out with a video here for you so that you can understand exactly what happened in 2008 to create the issues that really led to the Great Recession. And those issues have been since corrected when it came from, primary banks or mortgage lenders selling off their mortgage-backed securities on loans that were just really didn't have the backing. They were selling off and basically kind of being bribed as, hey, plus, rating loans when in fact they were D-rated loans, and it all came to a crash. That is something that was corrected by the Frank Dodd Act, which I've said in many other videos. But again, are we in a market correction? Do I anticipate the median values of homes here in the Treasure Valley and across the United States in itself to come down? Yes, because we are seeing price reductions on just about, a good majority of every single active listing that we have out there on the market today. So our buyers market is declining. And why? Again, because not only have the interest rates gone up to the point where it's wiping out levels of buyers, okay, and their affordability, but now the federal funds rate is coming up, which is just squeezing more money, and along with inflation, out of the pocket of the everyday American citizen. So do I anticipate the buyers' demand to keep coming down? Yes. Do I expect the median home values to keep coming down? Yes. I'm still anticipating about a 5 to 10% reduction is where I think that we're going to officially land, maybe more towards a 10%. But again, if they can't handle the rise in CPI, they can't handle the inflation rate, then that number could change. We could see it go down a little bit further. But as the recession comes around the corner, and if they're able to cap off the inflation rate, because you really got to cap off inflation before a recession can hit. And once that recession hits, historically, the rates will come back down in order to correct, and you can see the buyers jumping back into the game. So are we going to have record losses that we had back in 2008? No, don't anticipate that, but keep your eye on the ball. And most of the economists right now are saying that the recession should hit by Q4 or Q1 of next year. So keep your eye on that ball. And honestly, I can anticipate, I understand buyers, you're waiting to see, what is happening with a lot of this. But if you are making a move right now, prices are coming down. Even if you're at say a 5.5 interest rate locked on a 30-year fixed, that recession will hit, prices will, or the interest rates will come back down, and you'll be able to go ahead and refi. And I anticipate the housing market to continue to climb from there. We've seen it in the 80s, 90s, especially when a slight market correction happened in the 90s, everything continued to go up. To early 2000s, again, continued to go up in terms of the overall home values. 2008 was for a total different situation. 2010 continued to go up. We're seeing that market correction now. We just have to determine how low it's really going to go. But again, 5-10% is where I'm kind of guessing still at this point. So buyers, keep that in mind. Sellers, let's go ahead and get to you. All right, sellers. So as I mentioned, really the buyers' demand that we had like a year and a half ago or even a year ago has really subsided. And I think that you can see that, and especially if you have your home on the market now, you're probably, if you overpriced, you're seeing a price reduction on your house in order to be able to sell. As the buyers do dip out, anticipate the days on market to go up to as well, and just kind of hold on. But key is to appropriately price your home for sale in this market, going after really the world in terms of what you feel that your value of your home is worth. You'll probably notice right away, especially if you're not getting showings, etc., like that, that you're going to be overpriced, and a price reduction will be in your future. If you're still seeing anywhere from like 7 showings in a couple of weeks, maybe you're just a little bit on the overpriced side, and you'll have to come down a little bit if you're looking to sell your property. So sellers, stay vigilant. Just know that the buyer's market has declined. There's just not as many people out there right now willing to buy up your property unless it's appropriately priced right and they see the value in it. We're also seeing the shift over to the buyer's market. So one thing to anticipate is once that hits, the buyers are going to have more flexibility against your home to be able to negotiate for better terms, et cetera, et cetera. So very, very key to appropriately price your home. And if you're looking to sell, please feel free to reach out to me. Would love to sit down with you for about 15 to 30 minutes and discuss how to properly price your home in this market and sell it with all the right strategies. All right, investors, you're next. All right, investors. So you're probably holding on, just like the buyers are. You're waiting to see how much this is going to filter down. And that's not a bad thing. But of course, overall inventory, especially if you're in the flip game, is on the rise. So if you're in the flip game, you'll be able to find more inventory than you did, say, a year or a year and a half ago to a year ago, when people were, when our inventory is basically down to nothing. But we do know that our inventory is back up, extremely back up. I mean, almost a straight line, and I anticipate it to keep on rising. So sellers, buyers, keep that in mind. But investors too, if you're looking to invest in this market, feel free to reach out to me. All right. And lastly, renters, like always, renters, I always say this, you are paying 100% interest. You are helping out your landlord being able to make equity. Right now, of course, the market is softening. The market value is coming down, or the median home price is coming down, which your landlord is probably anticipating. But this is a great time to put yourself in that situation to wait for these things to kind of filter themselves out. Wait for the overall recession to hit, etc. So talking to a mortgage professional today is a good thing to be able to put yourself in that situation, whether it be maybe you don't think your credit score is high enough, or maybe to put away some more money to be able to make that down payment on your house. There's so many different options out there that I highly recommend. That, I mean, it's a great time to talk to a mortgage professional today. So if you're looking for a mortgage professional, please feel free to reach out to me. More than happy to put you in touch with one and get you in that position to be able to buy when the time is just right. Well, thank you very much, everybody. I really appreciate you taking the time out of your day to watch this video. I know sometimes it can kind of be lengthy, but I do like to give all the possible information that I can so that you're in key into what is happening in the market right here in the Treasure Valley. And of course, if you're looking to buy, sell, or invest, please feel free to reach out to me. You can reach me at 208-715-STAR. Again, that's 208-715-7827. And if you're looking to begin your shopping experience today for a home, please visit my website at www.yourstarrealtor.com. Also, if you're thinking about moving in from out of state, please click in the description button below, download my free relocation guide so that way you're in the know before you decide to make the move. And please hit that subscribe button below, click on the notification bell so that you're constantly in tune with all the videos that I do come up with. Thanks again, everybody. I look forward to the day that we speak. Look forward to the day that I call you my neighbor. God bless. Until then, thank you so much. Bye-bye.